So typically, when we actually look at buying a company, one of the main diligence questions we have is, what is our exit? In the sense that if we were to buy a business or invest in a business, what is the likely exit? Because you have to have a plan, because that's the only way you can have some view as to what the risk return profile of the business is. So what we'll typically do is really try to understand the landscape. Who are the big players in the space? Who are the up and comers who might enter the space? And that gives you a view for who potentially might be the acquirer of this business in the future. And if you think about it, there's really a couple of different of exit opportunities for any business. So there's the high profile IPO. There's a lot of interesting things going on now with these special purpose acquisition corporations, or SPAC IPOs. That's definitely for later stage businesses. There's the sale of the company to a strategic, sort of traditional merger and acquisition, where you sell your business to a larger player, or potentially sell it to a private equity player. So either sell it to a strategic or sell to a private equity player, and that's an acquisition through a merger. And those are typically the most likely exit. Realistically, if you're a small company today, the most likely exit is to sell to a larger player rather than an IPO. IPOs are a relatively small percentage of all exits. And then there's some other exits, a little less popular, but they exist as well as options. You lay them on the table. There's a sale of assets. Sometimes in a distressed situation, you might sell assets just to exit the business. And there's also a wind down or a bankruptcy. So the four options are really IPO, sale to a strategic via M&A, sale of assets, and then a wind down. So those are really the four exit opportunities that exist.